Ezra, welcome back to the Financial Shepherd Happy Hour.
Joshua, happy to be here.
Yeah, cheers.
Cheers.
Definitely a good week to do this happy hour. Kind of like the market today. Started out down and finished today positive. First time we did the Financial Shepherd Happy Hour last week, it was rainy. And, even though it's beautiful out here on the back deck for this particular happy hour, it was a pretty rough week for stocks.
It was. And despite rain being my favorite weather, that was quite the existential backdrop for how we were all feeling, wasn't it?
That's exactly right. And there's some obvious reasons for that. And the whole reason why we do this particular podcast, not just the Financial Shepherd podcast, but also the Financial Shepherd Happy Hour podcast live on YouTube here today, is simply because we want to inform the audience, my clients at Shepherd Wealth Management and those that are watching, following the show, what actually happened this week, why did it happen, why did the market kind of react the way that it did, and what can you actually do about that. So this is designed to be educational in nature, to give you the facts and give you my perspective on these facts and kind of what we're doing here for clients at Shepherd Wealth Management. So the main reason, the driver for all the volatility this week, you may or may not have heard. You probably heard, unless you were just completely off TV and every news outlet.
I live under a rock, under the sea, a pineapple actually. So.
Yeah, it's a great place with SpongeBob.
Right.
But the Federal Reserve Chairman Jerome Powell increased the Fed funds rate by 75 basis points about 9 days before the announcement.
Right.
The market was expecting a 50 basis point increase. He actually increased it to 75 due to last Friday's very hot CPI inflation data coming in at 8.6% when economists and analysts were expecting 8.2. So their job, as the Federal Reserve Chairman, is to do really two things. One is have maximum employment, and that's typically defined by about a 4% unemployment rate. We're at 3.6, and there's still 2 job openings for every person that's out there looking for a job. So that specific statistic in and of itself is probably the main driver and reason why we're not in a recession here. In the economy, although we'll get more GDP data coming out here in the coming weeks to help us, understand exactly where we're at as it relates to economic growth here in this country. But that increase in the Fed funds rate from 50 to 75 had an initial market rally, and then the very next day it gave up all those gains and then some. So this week, as I mentioned at the top of the show here, it was a very rough week for all the major averages. So the S&P 500 is down 5.6% this week. NASDAQ down 4.6% this week. Dow Jones Industrial Average, which is 30 stocks, down 4.5% this week. And to finish it off, the Russell 2000, which is your small cap index, down 7% this week. And the Wilshire 5000, which pretty much captures all stocks here in the United States, down 5.7%. And that's on top of the year-to-date losses that we've seen across all of these averages. So the S&P finally full bear market territory, down 23% year-to-date. NASDAQ's been in bear market for a while now, down 31. Dow's down 18. Russell 2000 is down 26%, and the Wilshire 5000 is down 33% year-to-date. In addition to that, so you have to chuckle a little bit when you hear these numbers, because we really haven't seen anything like this in quite some time, right? I mean, last 3 years, double-digit returns every single year. But I just gave you the facts of what happened this week, as well as year-to-date for all these major averages. And this has been 11 out of 12 weeks where the indices have been in the red. So it's been a slow grind down, and this week was kind of a more accelerated drift down. But what's most interesting to me, and I'd like to spend a little bit of time talking about this today, the only sector of the market that's been positive so far this year has been the energy sector. A lot of reasons for that. High demand for oil already, and then we get into a war, or we don't get into a war, but there is a war going on in Ukraine, and obvious reasons people did not want to buy Russian oil, at least in certain parts of the world.
Embargoes on Russian oil.
Exactly. Those barrels are finding a home in different places, India and China, maybe some others. But there's not enough supply to meet up with all the demand, which is why we're seeing $5 plus oil, $5 plus per gallon of gas.
Right.
Across the country. And the energy sector itself this week was down 16%.
That has so far been one of the strongest performing sectors, right?
The only sector that's positive
Yeah.
this entire year is energy, but this week it was down 16%. So why is that interesting to me?
Energy, here we go.
Yeah, I mean,
Joining everybody
you can't
else.
be positive all the time for all sectors. However, today was an opportunity for myself and my clients to go ahead and add to energy positions where we've had profits all year. I don't expect when I wake up on Monday morning that any of these things are going to be resolved. There's still going to be not enough supply to meet demand, and there's a food crisis going on. There's a fertilizer crisis going on. So we took advantage of that today on that weakness, adding to some of those positions. So that's the actual results so far this week, which again, another reason to have a happy hour. So
Do not.
if
Cheers.
beer is not your beverage of choice, I hope you're enjoying this beautiful weather with a glass of water, LaCroix, soda,
man.
whatever it may be.
Last time we talked about the coconut LaCroix, and I don't mean to divert, but I feel like we could get some positive news here in the happy hour before we break into the positive finance news. New flavor came out this year, at least for me. Cherry Blossom. Highly recommended.
Well, I haven't tried it yet, but I'll take your word for it.
Yeah.
May break it out here in the coming days. Now, I wanted to share a little bit of data. So obviously, I gave you a bunch of information about what actually happened this week as well as year to date. However, with all of the bad news, it's kind of like in baseball. If you go through a slump, eventually statistics are going to say you're getting closer and closer to your next hitting streak, right? So here we go. Bank of America, global investment strategist Michael Harnett points out the average peak to trough bear market decline is 37%. So the S&P 500 is down 23%. So it could suggest that there could be more downside to come here if the average is 37. And that actually lasts, on average, a bear market lasts about 289 days.
Okay.
Which means if we apply that math directly to 2022, the bear market would end right around October 19th. Now, obviously, if that happens, everybody's going to be pretty excited about it. But in general, you can't just look at, past performance and guarantee some sort of future outcome. I think everybody's kind of heard that disclaimer. So for all you compliance people out there, I got that in here. But that would mean October 19, 2022 would be, quote unquote, the beginning of a recovery.
Okay.
Right. And the interesting part about that specific date, that would land on 1987's Black Monday, which is one of the absolute worst days, one-day event in the history of the S&P. By the way, in 1987, S&P 500 was positive, even though it did actually experience a terrible day in 1987. They call it Black Monday. If you're not familiar with what I'm talking about, just Google Black Monday 1987. You'll get all the information you need on that. So that could put the S&P 500, if statistics actually play out and it gets down 37%, that would take the S&P 500 bottoming out around 3,000. Now, I have a difficult time seeing that the S&P would fall, another 600 plus points potentially in the coming months to get down to that level. But these are the historical averages, right? So you got to take it with a little bit of grain of salt, which means some instances were much worse than that. Some instances weren't as bad as that. But that is, in fact, the data. However, the good news is an end typically does mark a beginning, notes Bank of America strategist, noting that the average bull market lasts much longer. So I told you the bear market lasts on average about 289 days. Bull markets on average last about 64 months, with the average return being 198% over those days. So essentially, if the S&P goes down to that level of 3,000 and we have historical data type of recovery, you could see the S&P, somewhere around 6,000, which is essentially doubling, right, from where we're at. So we talked about this during our last happy hour. So what can investors really be doing, and what should they be doing? Well, what we just talked about with the energy sector also applies to all the other sectors that are down in the S&P 500. So we're just simply taking funds, either cash or profits from certain positions like energy, like a healthcare company, probably doing pretty well in a portfolio. We use one of them that we do use is United Health Group. So people are going to pay their premiums regardless if we're in a recession or not.
Right. Yeah.
Berkshire Hathaway has been an excellent stock. It's really well diversified in and amongst itself. And there's a couple others as well. So we can take cash, we can take profits, we can add to positions on these dips because we can't guarantee that these dates are going to happen at this specific time, that these numbers are actually going to occur. But we do know inevitably for every bear market, every recession, there's always been a recovery, and that recovery's lasted so much longer and been so beneficial for those long-term investors. Which brings me to a statistic that I think I shared, maybe not with everyone on YouTube just yet, but by missing the 10 best days in the market over the last nearly 100 years, if you just miss the 10 best days, your return essentially gets cut in half. And if you were to miss 30 of the best days in the market over the same span of time, your return essentially gets cut by about 83%.
Yeah, 83%.
Right. So we can't time this at all.
No.
Right. And you have to think long term as an investor because this is, the actual facts. Now, again, past performance is no guarantee of future results, but if anybody's expecting to have inflation at 9% or 8.5% forever now, like this is the new normal, I would disagree 100%.
Yeah, as would I. I mean, I just don't see how that would be possible.
No, it really isn't. I mean, the Fed is going to do the job of just slowing down demand. I mean, that's what they're doing by increasing interest rates.
Mhm.
And for those that maybe not 100% familiar with what that does to the economy, as interest rates go up, it's less likely that somebody's going to want to buy a new home, right? I refinanced before all this stuff happened, as millions of Americans did, and we locked in a rate around 3%, right?
Nice.
Now you're sitting here that if you were a first-time home buyer, as an example, and you locked in a 30-year rate, even if you had excellent credit, you're probably going to be somewhere around 5.5% to 6% in interest, so essentially doubling. So slow the housing market down, as an example, which has been on fire.
Yeah, and thankfully I don't have to worry about that because I still live in a van.
Yeah, down by the river. And so it also increases rents, right? I'm a landlord. I had to increase my rent because it costs more to keep up with things. So that'll slow down demand as well. And then, of course, on the business side, so corporations, the fund their future expansion, buying equipment, hiring employees, building out factories, etc. The cost of capital, to borrow that from a bank is actually increased substantially because of what the Fed is doing. So they're slowing demand, which eventually slows down the economy. They're trying to do it in such a way where they don't, quote unquote, break the economy, which historically speaking, they've never been able to pull this off. However, because of the labor market's so tight, as I mentioned, 2 job openings for every person that's looking for a job, that might actually be the one thing that actually saves us. And maybe the Fed will get lucky, and there'll be some sort of peaceful resolution in Ukraine.
The world would be lucky. Ukrainians would be lucky. If we
very, very lucky. Yeah. In addition to that, China's kind of opening up their economy once again after kind of having, lockdowns for the majority of this year so far. Yeah. So that can unbuckle some of the bottlenecks that we're seeing here in the supply chain as well. But again, even if all that plays out perfectly in the back half of 2022, none of those things are going to hit the inflation data numbers like immediately. It just doesn't happen overnight. And that's why I'm encouraging everybody out there that's watching and listening to this. I really do encourage you to look at your own situation, remind yourself why you're investing. I bet you're not investing to pay next month's mortgage, most likely. You should have emergency savings, and you should have parts of your portfolio that are cash and cash equivalents for those folks that are retired that actually do draw funds from their retirement nest egg to pay for things like a mortgage or, the trip that you're going to take this summer to go visit your grandkids or whatever it may be. Those are short-term needs, and you probably knew that those expenses were coming anyway, so you shouldn't depend on the market to be able to support those things. However, assuming that you do have emergency savings, assuming that you do have portions of your portfolio that are fairly liquid, now is an opportunity to say, okay, what's the reason why I'm investing? I'm investing for a legacy that I want to leave to my grandkids that I never received. I want to invest for my retirement. I want to invest for, the vacation home that I'd like to be able to have in some exotic place, right? I mean, remind yourself about why you're doing it, and I bet you there's a longer goal behind it. And if you think that way, this is, again, it's probably not the bottom, maybe no earnings, right? But those companies, the Apples, the Microsofts of the world, they're extremely attractive at these price levels. They're substantially lower than where they were just 6 months ago, let alone a year ago. And that kind of brings me to the last point of today's happy hour. So everybody's talking about, where is the bottom? Well, let's look at the actual results that have happened here. So we started this year, 2022, with the S&P 500's PE ratio being right around 22, which is historically higher than the average being right around 16, maybe 16 and a half. As we're talking today, the S&P 500's PE ratio looking forward is about 15.
Okay.
So we're a little lower, or about right in line with what the historical averages are. Therefore, you can look at positions and reasonably expect that you're getting a great value if you are a long-term investor, right? I'm not saying that we found the bottom, or you're going to see the bottom coming up here, on Monday. The data suggests that we might still have some downward losses ahead of us here before we eventually get to that recovery. But there's no guarantee that that's going to happen this time either. We could actually wake up, let's say July 1st, the month of July, first trading day, and everybody's excited because it just had an amazing July 4th, and all of a sudden everybody wants to buy stocks. Who knows?
Yeah, who knows? Yeah, you could get a dare, Uncle Ricky, that you won't throw into Amazon. You're like, saddle up.
Yeah, exactly. So dollar cost average your way into these positions. Don't throw it all in there at once, because you'll probably still see a few more events like we saw this week before we get that recovery. We're not going to get any earnings announcements for about 3.5 weeks. And there's probably really going to be nothing but headline news that investors are going to be looking at. And that's probably going to drive a lot of the outcomes that we'll see here leading up to earnings. So if earnings hold up kind of like they have this year, I think you're looking at a reasonably good opportunity to begin to add into positions that you feel comfortable with. And that's exactly what we're doing here for clients at Shepherd Wealth Management.
Right. And until those earnings reports come out and you're just going to see those headlines, be prepared for the doom and gloom. Do not lose your temper. Pay attention to the market, but you're going to see a lot of skies falling. And even if it gets worse, it's a long game, baby. Right?
It is, absolutely.
We're
Temperament.
playing a long game. Don't blow all your reserves now. You can't time the bottom. We talk about that all the time. You talk about that all the time.
Yeah.
But asset allocation, reallocating our names of the game for long-term investing. So do what you need to do. Keep your emotions even keel. If you can't do it, call someone like Joshua or whoever you trust, but just please. What's you like to say all the time? Don't bet like it's the end of the world, because even if it is, who are you going to collect from? Right?
Exactly. Right. And the world only happens once, so it's a bad thing to gamble on.
Yeah. And I think the last thing we'll be worried about is how are my stocks doing?
Exactly. Yeah. So temperament, as we talk about all the time on the show, as I talk about that with clients, that is your secret weapon in volatile moments. This is an inevitable event. Recessions will happen, bear markets will happen,
25% of the time.
About 25% of the time over the last, call it 100 years of stock market history, which also means that the market's positive about 75% of the time. The data that we just shared here today from Bank of America supports all of that. So your temperament is your secret weapon.
Totally.
Warren Buffett said it best. He would hire somebody every day and twice on Sunday that had a high level of temperament, that meaning they can keep their emotions under control, as opposed to hiring somebody with a whole bunch of degrees, next to their name. So I hope this is helpful. If it is, please subscribe to the channel here, and you'll get alerts every time we post a new podcast or a video. And feel free to share it with those that may also benefit from the information that we're sharing here today. It's been a pleasure providing you an update here this week. I look forward to a whole lot of weeks in the future here where we're getting the exact opposite results of the numbers that we're seeing this particular week. So cheers to all clients. Cheers to all people watching the Shepherd Wealth Management podcast. It's been a pleasure. Hope you guys have a great weekend. Take care.
See you next Friday, same time, same channel. So tune in
right.
for the live stream, Shepherd Wealth Management on YouTube. Take care.
Take care.